Overtrading involves an excessively high volume of trades. This volume is disproportionate to the trader's account size. It is often driven by emotional impulses rather than rational analysis. Overtrading typically lacks a well-defined strategy. This behavior can lead to increased transaction costs. Ultimately, overtrading often results in diminished returns and higher risk. Overtrading is characterized by an unusually high volume of trading activity. This excessive frequency suggests a trader's lack of selectivity in choosing trades. It also indicates impatience, as traders do not wait for optimal trading opportunities. Frequent trading can lead to increased transaction costs and reduced profitability. Identifying and managing overtrading is crucial for maintaining a disciplined trading strategy. Overtrading is characterized by excessively frequent trading activities. A key characteristic is the use of large position sizes relative to available capital. These large positions significantly amplify the risk exposure of each trade. This heightened risk can quickly deplete trading capital due to potential losses. Overtrading often involves entering positions without waiting for objective signals. Traders may act on hunches or gut feelings rather than concrete data. This approach lacks confirmation from reliable indicators or analysis. The absence of clear signals increases the risk of poor trade selection. Relying on intuition alone can lead to inconsistent and unpredictable results. Disciplined trading requires waiting for valid signals before entering positions. Overtrading often involves a pattern of chasing losses. This behavior is driven by a desire to quickly recoup lost capital. Traders may increase their risk exposure in an attempt to recover funds. This can lead to taking on even more risky trades than usual. The increased risk is intended to accelerate the recovery process. However, this strategy often exacerbates losses due to poor decision-making under pressure. Overtraders commonly disregard essential risk management practices. A key oversight is the failure to implement stop-loss orders. Stop-loss orders are crucial for limiting potential losses on trades. Another risk management neglect is ineffective position sizing. Appropriate position sizing helps control the amount of capital at risk in each trade. FOMO, or fear of missing out, significantly impacts trading psychology. It induces traders to enter positions based on others' actions. This is often done without conducting thorough independent analysis. Such behavior can lead to impulsive and poorly informed decisions. Ultimately, FOMO-driven trading increases the risk of financial losses. Revenge trading is characterized by a trader's impulsive attempt to recoup losses. It typically involves taking on more aggressive trades than usual. These trades are often poorly considered due to emotional decision-making. The primary motivation is to quickly recover from previous financial setbacks. This approach frequently leads to further losses due to increased risk. Revenge trading is a common pitfall in trading psychology. Boredom trading occurs when trades are executed due to a lack of engagement rather than strategic opportunity. This behavior often results in unnecessary trading activity. Unnecessary trades increase transaction costs without improving portfolio performance. Boredom trading elevates risk exposure due to impulsive decisions lacking proper analysis. Consistent trading success can breed overconfidence among traders. Overconfidence leads traders to believe future trades will automatically yield profits. This assumption often disregards market volatility and risk assessment. Traders may increase their trade frequency and size without proper analysis. Such behavior can lead to substantial losses due to increased risk exposure. Overtrading is a common pitfall in trading, characterized by excessive trading activity. A primary cause of overtrading is a trader's lack of patience. Impatient traders often struggle to wait for ideal, high-probability trade setups. This impatience leads to seeking constant action in the market. The desire for constant action results in entering trades that do not meet optimal criteria. Ultimately, this behavior increases risk and reduces the likelihood of profitable outcomes. Some traders exhibit a psychological need for constant market engagement. This need manifests as a compulsion to continually execute trades. This compulsion often leads to a pattern of overtrading. Overtrading occurs even when market conditions are not conducive to profitable opportunities. This behavior is driven by psychological factors rather than strategic market analysis. The thrill associated with trading can be psychologically addictive. This addiction stems from the excitement and anticipation of potential profits. The addictive nature can lead traders to engage in excessive trading behaviors. Excessive trading is often characterized by increased frequency and volume of trades. This behavior is driven by the need to constantly experience the excitement of trading. Inability to accept inactivity can negatively impact trading decisions. This intolerance often leads traders to force trades. Forced trades occur even when clear, high-probability opportunities are absent. Such actions are driven by a discomfort with being out of the market. This behavior typically results in suboptimal entries and increased risk. Overtrading frequently arises from a lack of a structured trading strategy. A trading plan should include defined entry conditions. Exit criteria must also be specified in advance. Without these guidelines, impulsive decisions become more likely. This lack of structure can lead to frequent and often unprofitable trades. A well-defined plan helps maintain discipline and reduces overtrading. Poorly defined entry criteria can lead to impulsive trading decisions. Inadequate exit criteria can result in premature or delayed trade closures. The lack of clear entry, exit rules increases the frequency of trades. This ultimately leads to suboptimal outcomes in trading performance. Overtrading can stem from the absence of structured risk management practices. A key risk management tool is the use of stop-loss orders. Stop-loss orders automatically close a trade when it reaches a predefined loss level. Another crucial aspect is adhering to position sizing guidelines. Position sizing involves determining the appropriate amount of capital to allocate to each trade. Without these risk management rules, traders are more prone to overtrading and excessive losses. Unrealistic profit expectations can significantly influence trading behavior. These expectations often lead traders to believe they can achieve unsustainable returns. In pursuit of these unrealistic goals, traders may engage in overtrading. Overtrading increases risk exposure and can lead to substantial losses. Overtrading involves excessive buying and selling of securities. One significant consequence of overtrading is increased costs. These costs include transaction fees, such as commissions, spreads. The difference between buying and selling prices also contribute to costs. These increased costs erode potential profits from trading activities. Therefore, overtrading can lead to diminished overall investment returns. Overtrading involves an excessive frequency of trades. Increased trading frequency elevates the potential for incurring losses. More trades mean more opportunities for errors and unfavorable outcomes. These losses, when accumulated, can lead to substantial financial damage. The compounded effect of frequent losses can severely deplete capital. Excessively large trading positions can result in margin calls. Margin calls require traders to deposit additional funds. These funds are needed to cover potential losses from the positions. Failure to meet a margin call can lead to forced liquidation of assets. This liquidation aims to protect the broker from further losses. Overtrading involves executing an excessive number of trades in a short period. This behavior often stems from emotional decision-making or a lack of a defined trading strategy. One severe consequence of overtrading is the potential for significant financial losses. Increased trading frequency leads to higher transaction costs, eroding potential profits. Overtrading amplifies the risk of making impulsive and poorly considered trades. In extreme cases, overtrading can result in the complete depletion of a trading account. Overtrading subjects individuals to a continuous stream of decisions. This constant decision-making process can lead to decision fatigue. Decision fatigue impairs an individual's judgment and analytical abilities. Impaired judgment increases the probability of committing errors in trading. These errors can lead to financial losses and poor investment outcomes. Therefore, avoiding overtrading is crucial for maintaining sound decision-making. Overtrading leads to increased stress levels. This heightened stress negatively affects mental well-being. Anxiety levels also rise due to overtrading activities. Emotional well-being is compromised by the pressures of excessive trading. Overtrading induces stress and fatigue, diminishing cognitive functions. This stress-induced fatigue leads to a decline in sound decision-making abilities. Impaired judgment results in suboptimal and potentially harmful trading choices. Therefore, overtrading indirectly increases the likelihood of financial losses. Prolonged overtrading can lead to burnout. Burnout is characterized by a loss of interest in trading activities. Traders experiencing burnout may also lose their passion for trading. This emotional and mental fatigue negatively impacts trading performance. Overtrading often leads to deviations from a trader's established plan. This deviation involves abandoning disciplined strategies. Instead, impulsive actions become the norm. This shift can undermine carefully developed trading approaches. Overtrading often leads to the pursuit of suboptimal trading setups. This focus on inadequate setups distracts from potentially more profitable opportunities. As a result, traders may miss out on higher quality trading scenarios. Missing these superior setups can negatively impact overall trading performance. Therefore, selective trading based on quality setups is crucial for success. Overtrading negatively impacts the consistency of trading performance. This inconsistency results in erratic trading outcomes. Erratic results lead to unpredictable financial returns. Reduced consistency makes it difficult to assess trading strategy effectiveness. Unpredictable results increase the risk associated with trading activities. Emphasize trade quality over quantity to improve overall performance. Establish minimum criteria for acceptable trade quality. Require multiple confirming indicators before executing a trade. This approach ensures higher probability trades are prioritized. Confirming indicators are used to validate potential trade setups. These indicators increase the probability of a successful trade. A minimum of 2 to 3 confirming indicators is recommended. This helps to filter out false signals and reduce risk. Entering a trade only after confirmation enhances decision-making. Key support and resistance levels are crucial in trading decisions. Traders should wait for these levels to be tested before acting. Testing involves price approaching or reaching these levels. This approach helps confirm the strength or weakness of the levels. Focus trading activities during high probability hours. These hours offer optimal market volatility. High probability hours also provide increased liquidity. Trading during these times can improve potential profitability. This strategy aims to capitalize on favorable market conditions. Position sizing is a crucial aspect of risk management in trading. Fixed risk rules, like the 1% rule, are used to determine appropriate position sizes. The 1% rule limits the potential loss on any single trade to 1% of the trader's capital. This approach helps to control risk and prevent significant drawdowns. Implementing fixed risk rules ensures consistency and discipline in position sizing. The 1% rule is a risk management strategy used in trading. It dictates that a trader should not risk more than 1% of their total trading capital on any single trade. This rule helps to limit potential losses from any one trade. Adhering to the 1% rule can protect a trader's capital and prolong their trading career. The 5% rule is a risk management strategy in trading. It limits the total capital at risk across all open positions. The maximum risk exposure should not exceed 5% of the trader's total capital. This rule helps to prevent catastrophic losses from any single trade or series of trades. A daily loss limit is a risk management tool used in trading. It sets a maximum percentage or monetary amount that a trader can lose in a single day. Once this limit is reached, the trader must stop trading for the remainder of the day. A typical example is a 3% daily loss limit based on the account's starting capital. This prevents further losses and emotional decision-making after a series of unsuccessful trades. Establish a fixed trading schedule to promote discipline. Adhering to specific trading hours helps prevent over-engagement. A structured schedule reduces the urge to constantly monitor market fluctuations. This, in turn, minimizes the temptation to overtrade impulsively. Setting boundaries for trading activity supports a more balanced approach. Ultimately, this correction fosters a more rational and controlled trading environment. Trade alerts offer an alternative to continuous market observation. These alerts help traders spot potential opportunities. The system identifies setups without requiring constant screen monitoring. This approach allows for more efficient use of time. Traders can focus on analysis and strategy rather than constant vigilance. Mandatory breaks are implemented between trading sessions. These breaks are designed to allow for emotional recovery. Breaks also facilitate mental recovery from trading activities. This helps traders avoid burnout and maintain focus. Mandatory breaks contribute to improved decision-making and overall well-being. Maintaining a detailed trade journal is crucial for effective self-correction in trading. The journal should meticulously track the rationale behind each trade entry and exit. Documenting your emotional state during trading is essential for identifying patterns. Record any lessons learned from each trade to improve future decision-making. Regular review of the trade journal facilitates continuous improvement and minimizes repeated errors. Weekly reviews should be conducted for all trades. The purpose of these reviews is to identify recurring patterns in trading activities. Reviews aim to pinpoint specific areas where improvements can be made. This systematic approach helps in optimizing trading strategies. Regular assessments facilitate continuous learning and adaptation. Ultimately, this leads to enhanced trading performance and profitability. The 24-hour rule is a strategy to manage emotional trading decisions. It advises traders to close all positions after emotional trades or significant losses. Following closure, traders should refrain from trading for a full 24 hours. This break allows for emotional cooling and prevents further impulsive actions. Effective trading requires a fresh and unbiased analysis. This approach emphasizes objectivity over emotional reactions. A fresh analysis involves reevaluating market conditions. It also means setting aside preconceived notions or biases. The focus shifts to interpreting objective data and trends. This data-driven approach enhances decision-making in trading. Reframing involves redefining the criteria for success. It shifts the focus from daily monetary gains to adherence to a predetermined plan. The original definition equates success with making money every day. The reframed definition equates success with perfect plan execution. This shift can provide a more stable and controllable measure of achievement. It allows for recognizing progress, even when immediate financial rewards are absent. Reframing an activity involves viewing it as a valuable skill. This perspective recognizes the strategic advantage of waiting. Waiting can preserve opportunities that might otherwise be lost. It acknowledges that not engaging in a trade can be more beneficial than a poor one. Avoiding bad trades protects resources and potential future gains. Therefore, strategic inactivity is a skill in preserving options and avoiding losses. Reframing effectiveness can be evaluated through specific quality metrics. One key metric is the plan adherence percentage, reflecting consistency in applying the reframing strategy. Setup quality scores assess the initial conditions and preparedness for reframing interventions. Emotional control ratings measure the degree to which individuals manage their emotional responses during the process. Monitoring these metrics provides insights into the success and areas for improvement in reframing techniques. Consistent tracking ensures the reframing process remains effective and aligned with therapeutic goals. Overtrading can lead to undisciplined financial decisions. Reframing involves identifying and addressing these detrimental patterns. One strategy is to implement a paper trading period. Switch to a demo account for approximately 1 week. This allows for rebuilding discipline without risking real capital. Paper trading provides a safe environment to correct overtrading behaviors. Financial markets operate continuously, presenting daily opportunities. Missing a single opportunity is insignificant in the long run. Focus on the multitude of future opportunities. Maintain a mindset that recognizes the abundance of market possibilities. A preservation-first mindset prioritizes the protection of capital. Capital preservation is considered more important than capital growth. This approach emphasizes risk management and loss prevention. It advocates for a selective approach to opportunities. Focus is placed on fewer, higher quality trades or investments. This strategy aims to yield better overall results through careful selection and risk mitigation.